Severe disruptions in the financial system can be very costly for society. As a result, banks are some of the most heavily regulated firms. In this session, we will describe how government regulation of banks works. We will see how regulators apply constraints on banks, what products they can sell, where they can sell those products, and so on. We will also see examples of what happens when banks break the rules. The Basel Accord provides an important case study. We will see how it provides a global standard on the loss-bearing capacity of banks. Our discussion will focus on bank regulation, but I first want to draw the distinction between bank regulation and bank supervision. They're closely connected, but we are going to consider them separately. Regulation now, supervision at another time. Okay, when governments regulate banks, they establish a set of specific rules that banks must follow. These rules are usually written under the authority of some law passed by the government. Congress passes the Glass-Steagall Act. This calls for the separation of commercial and investment banking, and then the regulator implements the rule. Supervision involves continuous oversight of the banking system. If banks break the rules, then they are punished. These are called enforcement actions. Supervision often has a much narrower focus on the safety and soundness of individual banks. The government inspects banks' financial reports, conducts on-site examinations, and annual stress testing. You might have read about stress testing in the newspaper. This has only been around for a decade or so. We are focusing on regulation. What are the most important rules that banks must face? What is regulated? There are restrictions on competition, what banks can do once they enter the market, both in terms of their investments and their funding, and there are disclosure requirements. Let's unpack how these regulations work. First, we have competition. In order to open a bank, you must get approval from a federal or state regulator. Bank mergers require government approval. Until recently, the geography of banking, where banks could branch, was restricted. When it comes to industry exit, there is no bankruptcy process. The FDIC resolves distressed banks. Too much competition may induce banks to gamble for survival. Too little competition makes the government worry about customer exploitation. Hence, we have these rules. Second, we have activities and investments. In the past, deposit-taking commercial banks could not do securities underwriting. Nowadays, there are limits on proprietary trading. In terms of their financial assets, banks cannot hold stocks. They are too risky. There are also restrictions on junk bond holdings. These regulations directly target the risk-taking of banks. There are restrictions on the funding side of the balance sheet as well. Banks face caps on leverage. These are expressed as minimum requirements on equity funding, which we will discuss as a case study in a moment. The use of wholesale funding is also closely watched. Having stable funding that can cushion banks against losses will help to reduce the risk of failure. Finally, we have disclosure requirements. Banks must tell their customers how much a credit card is going to cost them. Banks must publicly disclose their financials in a standard format and on a regular basis. This allows both regulators and financial markets to discipline banks that take on too much risk. Who regulates? In the US, banks are regulated and supervised by a group of nationwide and local agencies. All banks have deposit insurance, so the FDIC, the Federal Deposit Insurance Corporation, is top of the list. Then we have the Federal Reserve System, the Office of the Comptroller of the Currency, which is a sub-agency of the US Treasury Department. And then many smaller banks are regulated at the state level. The US is fairly unique in terms of its number of regulators. Other countries have just one bank regulator, usually housed within the central bank. Let's talk about capital requirements in more detail. Let's do this in the context of the Basel Accord. You can think of this as a global minimum tax on bank risk-taking. The historical setting is interesting. It is the 1980s. Banking is becoming more and more global, so a bank based in the Republic of Ireland could lend in the US. However, if the Irish bank was subject to looser regulation than the US bank, then this might be a problem. The US bank would be at a competitive disadvantage. To keep their own banks competitive, US regulators might face pressure to lower their own regulatory standards. There could be a race to the bottom in regulation. The Basel Accord was the solution. In 1988, global banking regulators met in Basel, Switzerland. These regulators developed new rules to promote a level playing field for all banks in all countries. The Basel Accord focused on the loss-bearing capacity of banks. It encouraged banks to use equity capital to fund their investments. More capital means a greater cushion against potential losses and hence a safer global banking system. Specifically, the agreement focused on minimum capital requirements. Roughly speaking, banks must finance each dollar of assets with at least 8 cents of equity. I say roughly because the rules accounted for the riskiness of a bank's investments. If a bank only invested in super safe, AAA-rated government bonds, then it would need a smaller equity cushion. The capital requirements are risk-based. Here we can see the capital ratios for the largest US banks, JP Morgan, Bank of America, and so on. This is data from 2017. These are not simple capital ratios, that would be E over A. They are risk-adjusted capital ratios. So E over something called risk-weighted assets. The actual process of accounting for risk is complex and has changed over the years. We have gone from Basel I in 1988 to Basel III in 2010. However, the basic idea is the same. Per dollar of risky investments, all banks need at least X cents of equity. In 2017, the minimum was 6 cents. All of these large banks comfortably met their minimum capital requirements. This is possibly why they were so well positioned when COVID hit in 2020. Let's wrap up. This time, we were more specific about bank regulation. Regulation applies constraints, it bans certain risky activities, it encourages banks to do things that they might otherwise overlook. We discussed the Basel Accord as a case study. The Basel Accord set minimum capital requirements. This is a global standard that ensures a level playing field. The initial agreement came in 1988, and the most recent iteration, Basel III, was announced in 2010.